the Marathon Palladium, Copper, and Platinum project in northwestern Ontario. So, for those of you that don't follow palladium, palladium is not like these other metals, the metal of the future or the metal for the green metals of the future. It's actually a green metal now. Its use is almost entirely in catalytic converters in cars. And what the catalytic converters convert is carbon monoxide, which is poison. And just as important, it converts nitrous oxide. And you don't hear much about nitrous oxide, but nitrous oxide is actually 300 times as potent a greenhouse gas as carbon dioxide. And you don't hear about it much because of palladium. Palladium converts that into nitrogen, which already makes up 70% of our atmosphere. And so it's extremely important to gasoline cars and reducing the greenhouse gases. We've got 4 million ounces of that in measured and indicated. We've got another bunch in inferred. Well, we've also got 1 billion pounds of copper as a byproduct and over 1 million ounces of platinum. So we have a nice suite of metals. We also have some gold and silver, which I'll talk about in a moment. So as far as the people goes, we have a really strong group of people. That group is growing. Jamie Levy and I have been working together for about 8 years. Our last company was Pine Point Mining, which got taken over by one of the OTCQB companies. Previous to that, entirely in my career, I've started 6 mining companies before this one. 4 of those made it into production, and all 6 have been taken over. So I've had a decent track record. Drew Anwell joined us about a year ago. He was one of the 3 key guys behind building the Detour Gold, the big gold mine in Northern Ontario. He did about 2 months of due diligence on us before he joined us, and he was looking for the next mine that he could build. And Brian Jennings has got an extensive experience in restructuring companies as well as chief financial officer of various mining companies. And I won't get into all the people, but as far as the directors go, we've got a very strong group of people here, all at the top of their game in the mining business. We have a lawyer, we have an accountant, we have an engineer, we have a geologist, and we have a geophysicist. And they are a very active board of directors. So location, very important for a whole pile of reasons. One, of course, being the access we have to infrastructure. Another one being the access we have to clean electricity and cheap electricity, and another one having the community support of both the First Nations and the local non-Indigenous communities as well. And we're probably in the most active mining area in Canada. The Hard Rock mine just to the north of us is going ahead now. The Alamos has expanded the Island Gold Mine several times. Magino's under construction. The Hart Gold Mine was built a couple of years ago. And there's a number of other development projects in the area. And Canada's only palladium mine, which is owned by Impala, a South African company, is just to the northwest of us. Getting a little more local, we have the Trans-Canada Highway coming through the property. We have a CPR main line. The town of Marathon, which supports the big Hemlo mine, is just south of us. We've got 3 deposits on the property, and the blue area is our property, but the feasibility study we did was strictly on the Marathon deposit. And as you can see, we're just north of the airport there. And one of the key things here is this power line. The government of Ontario has just spent $1 billion upgrading this power line to bring clean power to this part of the world. And we are going to be the beneficiary of that. The Hard Rock mine, for example, to the north of us, they have to use natural gas and generate all of their own power. We're going to get it all off the grid, and it's going to be cheap and it's going to be clean. Ownership, we own just right now, right around, it's just approaching 83% interest. We have a partner, Sibanye-Stillwater. Those of you who follow us will remember that Sibanye had a one-time back-in right after the feasibility study. It was very onerous. We didn't expect them. We never expected them to exercise. The market did, unfortunately, and it kicked our stock down a bunch. But we never believed that they would exercise. And in fact, we're now negotiating with them to buy them out. Not sure we'll get there, but if we do, we'll have 100% of the project. And the real key here for the people want to know why Sibanye walked. Well, one of the reasons was how onerous it was. They would have had to spend more than $250 million to buy into this, just as their initial down payment to buy into this project. It didn't make economic sense. The other reason that they have stated publicly and by their actions as well is they have decided to go after battery metals. So they bought a nickel refinery in France, they bought a lithium project in Finland, and now they just committed $500 million to a large lithium project in the United States. So they're moving in that direction. It's kind of odd for a precious metal company, but that's where they're going, and I wish them well. They have been a good partner, but we're going our separate ways now. So we did a feasibility study that came out in March. It was done by the top tier engineering firms, G Mining and Ausenco. Showed a 13-year mine life with about 245,000 ounces of palladium equivalent a year. And the upfront capex is $665 million, and we can produce the palladium for just over $800 an ounce. The base case at 1725 palladium, IRR is 30%. That's a good number. You don't see less than a quarter of the mining projects are above 30%. And the net present value is $1 billion against our market cap of just over $100 million. And that's at much lower than current prices. If you look at more closer to spot prices, and if you look, for example, at today's spot price of both copper and palladium, you've got a $1.6 billion net present value. At the spot prices when we came out in March, the net present value was $2 billion. By the way, at spot prices, the payback on this project is 1.5 years, almost unheard of for a greenfields mine construction. And the base case, even at the lower metal prices, we've got a 2.3-year payback, which the bankers love. So the bottom half of this slide shows the distribution of revenue. As you can see, we're primarily a palladium mine, but copper has a big impact, and that's at 320 copper. It's 27% of our revenue. At 450 copper, where it was, we calculated that to be quite a bit higher. We're now approaching 40% of the revenue. So it is a significant copper development. And this just shows the base case, the undiscounted cash flow at the spot price of $5 billion over the life of the mine. And that's a 13-year mine life. And that only counts the main zone. We have other deposits on the property that will extend that mine life further. So fantastic cash flows for a company, given our market cap today, almost $1 billion over the first 3 years, and averaging close to $200 million for the rest of the mine life. So very good numbers. And that's, again, at the base case. We've designed this mine to focus on the palladium in the first half of the mine life. And the reason for that is because we do think that in time, palladium will start to back off in terms of importance as the world goes towards electric cars. We think the rollout of electric cars is going to be a little slower than a lot of people think. But nevertheless, it's going to happen. So we're getting 2/3 of the palladium out in the first half of the mine life. And then we've reserved a lot of the copper for the second half of the mine life, because we think if electric cars get popular, well, and I'm sure other people can tell you the same thing, there's not enough copper in the world for the whole world to go to electric cars. So copper is going to become a very valuable commodity. And then we've got all these other metals. We've got a good amount of platinum, in many of the years, 60,000 ounces of platinum as byproduct. And of course, platinum is supposed to be important for the fuel cells, which may be powering buses sooner than we think. We've also got some gold and silver, and we've been in discussions with a lot of the streaming companies to stream that gold and silver, and we're getting a phenomenal response partly because of our location, but it's just it's really pretty exciting for us that we think we're going to be able to finance a large part of this mine by streaming the gold and the silver. And then quickly on the sensitivities. If you look at current palladium price is just over $2,000 an ounce. That adds $300 million to our market cap. If you look at current copper prices, it adds almost $300 million to our not our market cap, our net present value. So very sensitive. But what's really I love about this slide is if you take almost $1,000 off the current palladium price, and palladium, of course, has already dropped $800 this year because of the slowdown in automobile sales due to the chip shortage. But if you knock almost another $1,000 off the price, we still have, and this is still at 320 copper, we still have that 20% IRR, which to me is the threshold which determines whether or not you should be building a mine. Location, important. So this kind of summarizes the carbon footprint of the 5 largest palladium producing areas in the world. 3 of those rely almost exclusively on coal. It's not really that great for our environment to use coal to produce electricity, to produce green metals, or for that matter, electricity for electric cars. Ontario is 96% carbon free. Only 4% comes from carbon, and most of that is in the GTA with gas plants that come on during peak times, not up where we are. So almost virtually a carbon-free area. And we are looking at we don't have our carbon footprint figured out right now because we are looking at using electric assist trucks to lower our carbon footprint even further, and also even electric shovels in the pit. So we're doing all those cost trade-offs. We're negotiating with Ontario Hydro to figure out what our exact electricity cost is going to be, et cetera. And here's the palladium story. Again, palladium is in shortage. It remains in shortage. It's gone into a little bit of a surplus right now because of the reduction in car manufacturing. But that car manufacturing, when the chips are available, is going to explode back, and so we expect the palladium demand to explode back as well. Just to put our mine in perspective, if you look at the largest precious metal mines in Canada, if we were in production today, we would be number 7, ahead of Rainy River, ahead of Hemlo, and if you did a gold equivalent on that, it would be just around 300,000 ounces a year. Yet we're trading at the very bottom end of the net present value of the development companies. And a lot of reasons for that. One is people think that Sibanye, since they walked away, this is not a good project. That's not the case. Number one, Sibanye is still a shareholder of ours and has not sold a share. The second knock we get, of course, is that how is a junior company like you going to raise $700 million? Well, I've raised $1.5 billion in my career, and this project is robust enough. And I've never, ever been in a situation where there is so much money available to build mines. It's coming from private equity companies, from streamers, from smelters, all over the place, lenders. And we're in discussions. We've got NDAs with over 20 financial groups to figure out how that mix is going to happen. But I can assure you it is going to happen. So what's going on in the future? Well, we're working on our permits. We're expecting, with a little bit of luck, to have that all wrapped up within a year from now. We're also about to start the detailed engineering, which we need to do so that we can hit the ground running once we get our permits. We're also negotiating with the local communities and First Nations. We've got a letter of intent with the Maine First Nation. And in fact, our top management is on site today with the at the First Nations, presenting to the government, to the panel who's looking at our permits. So we're working very closely with the First Nations, and with a little bit of luck, we're hoping to start construction in the third quarter of next year, July, August, and if that's the case, it's about 18 months or 20 months to production after that. Just a quick note, we are continuing to explore. We've made a fairly major discovery 300 meters to the north of the main pit. So this thing is getting bigger. And that's what some of the core looks like. And just to finish up then, we've got 150 million shares outstanding. We've got some pretty smart shareholders. Eric Sprott's been in our last 2 financings. Lucas Lundin has been in 3 of 4 financings. Sibanye is a shareholder and has never sold a share. And Osisko Mining trades our stock pretty actively, but has been in every single one of our financings and has done very well. Directors and officers all bought their shares out of the market or in the financings. There was no founder stock in this market, in this company. All of our shares, and that's well over 10 million, were bought at the same price as the rest of the market had to pay. And our market cap it's come down a bit from this. It's palladium has had a rough couple of months. The reason for that is, again, the chip sales or the chip shortage in the cars. Toyota announced a couple of days ago that the October production would be down 40% year over year, and that knocked about $200 off the palladium price. But the palladium price will come back. It's still in shortage. There's no new mines coming on anytime soon. there's no replacement for it. So we're pretty confident on the palladium market. Thank you.